Time now for Hot Picks, and today we're focusing on the auto sector. And to do that, we're joined by Garrett Nelson, Senior Vice President and Equity Analyst at CFRA. Garrett, great to have you with us. Okay, let's just start with the backdrop for investing in the automotive world right now. What do you have to think about as an analyst when you're trying to pick winners?
Sure, thanks for having me. So the backdrop for the auto names is that the sector, the industry has really been beaten down by tariff-related concerns here in the U.S. It was a very ugly first quarter for these stocks, but they have since come back in the second quarter. And the reality is, for most of these companies, especially in auto retail, their earnings peaked in 2022. So it's been 3 years now of pretty disappointing sales, which have weighed on the bottom line. But we think the setup looking out over the next 2 to 3 years is much more favorable for these names, and therefore they provide a good entry point at these levels.
Okay. Now, your universe of stocks is not just companies that make cars, it's people that traffic in the world of vehicles. So one name that you highlighted is CarMax. This is it's almost like the Walmart of used cars. It's a pretty effective business. It is under some pressure this year. What is it that gets CarMax onto your list? You have a pretty positive view on the company.
We do. They just reported earnings a couple weeks ago, and it was a very strong quarter. We raised our price targets. Our 12-month price target is $100. We have a strong buy on the stock. This is one of the strongest earnings growth stories in auto retail. We project that their earnings will be up 32% year over year in fiscal 2026, followed by a 16% increase next year. What's really driving that is affordability is still a major concern. And so we think the company really benefits from consumers trading down to from higher priced new vehicles to lower priced used vehicles. And CarMax is basically a used vehicle pure play. They also have a lot of tailwinds on the margin side. CarMax is one of the more tech-savvy auto retailers out there, and we think they're doing a lot internally to drive productivity improvement. And so the combination of higher sales volume, higher used vehicle prices, and better than expected margin should really produce significant bottom line uplift over the next couple years. One other thing we would highlight, in the most recent quarter, their share buybacks more than doubled from the prior quarter on a sequential basis. So they're buying back a lot more stock, and we think that sends a strong signal to investors regarding the company's prospects going forward.
Okay, let's stay with auto retail, because AutoNation is another company that you like. Why?
Similar to CarMax, except they're a mix of both used vehicles and new vehicles, but they're growing their used vehicle segment significantly or on an organic basis, opening a lot of used vehicle only stores. This is probably the most shareholder friendly company in auto retail. If you look back over the last 4 years, they've bought back more than half of their total outstanding share count. We do screens on all the stocks we follow on a technical basis, and I can tell you that AutoNation has the highest technical rating of any stock that we follow in our coverage universe. We have a strong buy on it, and we just really like the strong cash returns to shareholders that they've delivered over time, and so we're very bullish on AutoNation going forward.
Okay, so we've covered a couple of retailers. Now let's get into an automaker. General Motors makes your list. Why is GM a hot pick in your opinion?
So this is a stock that was hit very hard in the first quarter due to tariff-related concerns because they're such a significant manufacturer. They have such significant operations both in Mexico and in Canada. So the tariff-related concerns really weighed on the stock's performance in the first 3 to 4 months of the year. It has since come back. The story here is they've been buying back a lot of stock, reducing their share count, and we think that's going to result in above average EPS growth relative to other traditional auto manufacturers. They've been growing market share significantly over the last couple of years in the U.S., their most important market. And we really like the setup going forward. Like the other two names, we're seeing a lot of consumers are pulling back on buying autos in anticipation of lower interest rates over the next year or two. So, we think that's going to happen, in the coming quarters. That, the timing is up for debate, but we do think the Fed is going to cut and interest rates are going to come down. And that's really going to provide an uplift on the top line for General Motors and the auto space in general.